Welcome to Bitcoin in Free Fall. I'm Jonathan Meyer, your financial analyst and cryptocurrency correspondent. Today we're examining Bitcoin's significant decline to a 6-month low, currently hovering around $94,000 to $95,000, and what this means for the market. The world's largest cryptocurrency has fallen over 20% from its peak of $126,000 in early October. This dramatic sell-off has been largely fueled by substantial outflows from Bitcoin ETFs, with investors pulling approximately $870 million in a single day recently, marking the second largest ETF outflow on record. Over the past 3 weeks alone, we've seen withdrawals totaling $2.64 billion, demonstrating a significant shift in investor sentiment. What's particularly telling is the current state of the Crypto Fear and Greed Index, which has plummeted to extreme fear territory, levels we haven't seen since February of this year. This psychological indicator reveals the depth of uncertainty and anxiety currently pervading the cryptocurrency market. Adding to this perfect storm, we've witnessed massive liquidations exceeding $1 billion in a remarkably short time frame. These liquidations have predominantly affected leveraged long positions, essentially bets that the price would continue rising. When prices began to fall, these leveraged positions were automatically closed, creating a cascade effect that further depressed prices. But what's driving this shift in market psychology? One key factor has been the Federal Reserve's position on interest rates. Recent signals from the Fed suggesting a more restrictive stance have dramatically reduced expectations for a December rate cut. Markets now price in only about a 50% chance of a December cut, down from nearly 90% earlier this month. This has prompted investors to move away from riskier assets across the board, affecting not just crypto, but technology stocks as well. Beyond the macro factors, we're seeing what psychologists might call momentum reversal. When Bitcoin crossed below the psychologically important $100,000 threshold, it triggered a wave of selling that becomes self-reinforcing. Long-term holders started selling, further pressuring prices and creating a negative feedback loop. It's a reminder that cryptocurrency markets remain highly susceptible to emotional trading and herd behavior. The institutional landscape has changed too. Many of those ETFs that saw record inflows earlier this year are now experiencing significant outflows. This suggests that some institutional investors may have been positioning Bitcoin as a tactical rather than strategic allocation, willing to reduce exposure when market conditions shift. Looking ahead, what can we expect? While the short-term outlook remains challenging, historical patterns suggest that periods of extreme fear often precede market bottoms. We might see consolidation around current levels before any sustained recovery begins. The $84,000 to $95,000 range appears to be a significant technical support zone that traders will be watching closely. For long-term Bitcoin believers, these market corrections, while painful, have been characteristic of previous cycles. Remember that Bitcoin is still up significantly from where it started its bull run last year, despite the recent drawdown. Historically, periods of extreme fear have presented buying opportunities for those with conviction and patience. The key indicators to watch going forward include ETF flows, which provide insight into institutional sentiment, macroeconomic data that might influence Federal Reserve decisions, and on-chain metrics that show whether long-term holders are continuing to sell or beginning to accumulate again. As we navigate through this period of heightened volatility and uncertainty, it's worth remembering that market psychology often swings between extremes. Today's fear could be tomorrow's opportunity, only for investors with appropriate risk management and a clear understanding of their investment time frame. This has been Bitcoin in Free Fall. I'm Jonathan Meyer, and thank you for listening.